Equities in the US kicked off the week on a positive note, while equities here in Europe had a bearish start to the week due to a China-led sell-off in commodity and luxury stocks. So all eyes are on the US retail sales data today. A soft data could further fuel the dovish Fed expectations and weigh on the US dollar. So welcome. This is Swissquote's Daily Market Talk. So there are a few stories developing at the same time these days, parallel to each other. There's this Trump trade, there's this China trade, the reflation trade, and the AI trade. So we will talk about all that, but let's first start with the Trump trade, if you will, which basically consists of going long Bitcoin and short the long-term US Treasuries on expectation of exploding US national debt with tax cuts, higher spending from the Trump administration, and growth supportive Trump policies if he's elected president. So the yield on 30-year treasuries yesterday surpassed the rate on 2-year notes for the very first time since January this year. The 30-year notes reflecting the exploding spending and debt levels in the US, while the 2-year notes benefiting from the rising Federal Reserve rate cut bets, as the Fed President Jerome Powell reiterated on Monday that recent data boosted confidence that inflation in the US is heading toward the Fed's 2% policy goal. And other than that, Trump's media company jumped more than 30% at yesterday's trading session, obviously following the murder attempt on Trump over the weekend. Oil producers and gun makers are also quite good picks for a Trump trade, while solar and pot stocks may come under a decent pressure moving forward, as Democrats are thought to be more favorable to these businesses in these sectors than Trump himself. But overall, the Trump effect for the financial market, equity markets, is positive, at least for the US equity markets, to say the least, and also cryptocurrencies. Now, nothing to do with Trump this time, but Apple's 1.67% surge to a fresh record high yesterday, following news that its annual sales in India hit a record of $8 billion on path to potentially offsetting the Chinese weakness for Apple, and after being named a top pick at Morgan Stanley, also helped the major US indices do better at yesterday's trading session, while Goldman Sachs stock price jumped more than 2.5% yesterday after announcing its quarterly results. So Goldman Sachs announced a much meager investment banking revenue growth in the second quarter compared to JP Morgan and Citigroup, but the trading unit and capital markets business at Goldman Sachs did actually better than expected by analysts. And the Trump trade is also positive for bank businesses, mind you. As a result, US kicked off the week on a positive note for its equities after the murder attempt on Trump, and all major US indices, so the S&P 500, Nasdaq 100, and the Dow Jones Industrial Index eked out gains yesterday, as the Russell 2000 index jumped 1.80%. Here in Europe, sentiment was much less cheery, believe me. Because first, the Trump trade is not necessarily positive for the European stock markets, as who says Trump also says higher tariffs and increased trade tensions, yes, with Europe as well. So that's one thing. Then there's this China trade, where China's inability to print sufficiently strong growth numbers weighs on energy and commodities that are obviously heavily represented in the British FTSE 100 index, for example, and on the European luxury stocks that are heavily presented elsewhere. As such, Shell and Total Energies, for example, in Europe fell on the announcement of a weak growth number from China at the start of this week, while their US peers gain on expectation that Donald Trump will actually go slow on the climate-friendly policies and give support to the traditional energy businesses in the US. In the luxury space here in Europe, Burberry tanked 16%. Yes, 16% yesterday after issuing a profit warning and after replacing its CEO. Then the Swiss Swatch Group here in Switzerland lost almost 10% yesterday after slowing spending in China in the first half of this year led to a 70% decline in its operating profit. Now, happily for the European stocks, the reflation trade is providing a certain boost as the interest rate cut bets from major central banks are fostering better sentiment for the reflation-friendly European equities and also supporting commodities businesses, or the expectation on commodities which are weakened by China's economic slowdown. But alone, hope of lower interest rates may not suffice to keep the European Stoxx 600 index near record levels as Europe's 12-month forward earnings revisions ratio, which is simply a gauge of analyst upgrades versus their downgrades, moved further into the negative territory before companies started reporting their second quarter earnings in the Eurozone. So you could argue that softer earnings expectations are easier to beat, of course, but do they really justify a rally to, fresh all-time high levels is just another question. Then there's this AI trade, obviously, which has been pushing the major US indices to record after record since the beginning of last year, but where the high valuations start giving a foolish smell, suggesting that a correction, a sizable correction, could be quite near. So the expectations here are robust, mind you. The big technology earnings should slow, but they should remain strong, whereas the non-technology earnings are expected to print a positive earnings season after quarters of struggle. So that, combined with the rising odds of a September rate cut from the Fed and also the heightened odds of a Donald Trump victory this year, keeps buyers in charge of the market. But as I keep repeating, if the big technology starts falling, the other sectors will hardly make up for the drop because they have neither the potential nor a justification to do so. So all in all, uncertainties loom right now as equity markets on both sides of the Atlantic Ocean continue to flirt with record high levels. So due today on the economic calendar, investors will be focused on Canadian inflation print and the US retail sales. Retail sales in the US are actually expected to have fallen 0.2% in the month of June. So such weakness in retail sales numbers would back the Fed's easing inflation story and further reinforce the expectation of a September cut from the Federal Reserve. So we could then see the US dollar index make a decisive move below a major Fibonacci support, which is the major 38.2% Fibonacci retracement that stands near the 104.20 level, and step into the medium-term bearish consolidation zone for the very first time since the beginning of this year. So if that happens, the price action would perfectly reflect the Fed rhetoric in the US dollar and give a further confidence regarding the weakening US dollar outlook. And the latter would inevitably boost the currency valuations elsewhere. And that boost to currency valuations elsewhere would ease the dollar-led inflationary pressures elsewhere as well. So the euro-dollar tested the 109 offers yesterday, while cable is flirting with the 1.30 psychological resistance these days amid a broad-based US dollar weakness and also ahead of the latest CPI update from the UK due tomorrow. So the UK's headline inflation is expected to have eased below the 2% mark in some analyst surveys, but services inflation in the UK and also the jobs data from the UK will also play an important role in shaping the Bank of England expectations for the August meeting. So a sufficiently weak set of economic data from the UK this week will make the sterling bull's job harder near the 1.30 psychological mark, while any strength in this week's economic data could actually get the Bank of England those to further scale back their interest rate cut expectations for the August meeting and pave the way for a further rally in cable to above that 1.30 psychological mark for the very first time in a year. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.